Hello guys, good evening. I hope you all are doing well. Today I want to talk about the dollar index, and I think with this I can conclude on how the year is possibly going to end for us concerning trading in currency pairs and also in crypto and the stock market. So we'll not be having focus on crypto, just the currency pairs and the stock market. So I want us to look at what DXY, the dollar index, is doing, and I'm going to give you guys a full breakdown analysis. But also, I'd like you guys to have a reference to the Richard Wyckoff analysis, like the PDF, because with this, I think you can use this to understand what I'm going to explain on this video concerning the accumulation phase. Right, so if you don't have the PDF, you can actually download it from your Google search, like search about the Wyckoff PDF. I think it should be this one, Richard Wyckoff, and his method and study, blah blah blah. So I think when you click on that, you can actually see it shows you that it's PDF. So when you click on that, you can possibly download that. Yeah, so going back to the dollar index, I want us to go over to the higher time frame and we'll be looking at the 12-month time frame. All right, let's use TVC. All right, so this is what we have for the dollar index, and I'll be taking off all my charts except for the red horizontal line. So now looking at the dollar index, the first thing that I want us to notice or take note of is our external highs and external lows. Because that would be the range that we will be dealing with, the range that we'll be dealing with. So I'll first of all draw a schematic. So let's say this is our external high and this is our external low. So once that low has been formed, we actually do know that price we like to retrace back into equilibrium, which is around the 50% level, and also into the premium pricing. So if this is expected to go bearish, price would sell from there and then come down back to the external low and take that as the liquidity. So let me give you a breakdown on how it works. So let's say that the market gives us a high and a low, then it trades backwards. And while trading backwards, we're looking forward to see if it goes to this high. In most cases, it might fail to go to that high. And in some other cases, it will go for the high, take a stop hunt, and then comes back lower. So when it starts to trade lower and change structure from the bullish movement that was trading higher to go for the external high to a bearish market, you can actually tell that, okay, we have taken liquidity from this high, we'll be going for liquidity for this low, and price will be drawn to that low. And then the same thing occurs, and that leaves it in a ranging market. All right, so that is how it works. Then also, whenever you notice that you are in a range of a high or low and price starts printing a bullish structure, you should pay attention to it. All right, because that is a retracement to fill up areas of inefficiency and should be traded into a premium pricing when we have the fair value gap, the old blocks, and your supply, right, where it's going to sell from. So our main focus will be that bullish trend pushing the price higher to fill up the inefficiency from our range. All right, so if price traded to the premium pricing, all right, we are still maintaining a bullish move because these are creating areas of demand to continue pushing the price so that it can be drawn to liquidity resting on this high. Now, in most cases, when price trades into premium pricing, let's say a fair value gap on order block, we are not expected to go bearish until we see the demand that is supposed to push the price higher to be drawn to this external high is being violated. That is when we'll be looking for us to go bearish. All right, so if price is going bullish, we trade into a demand zone, price will show a reaction that it wants to go higher. So let's just say that it's not going to go to this high, right? It is going to fail. After it fails to give us a new high and be drawn to this high, we are going to see it break that demand zone that was pushing the price higher. All right, not this low, the demand that was pushing the price. So that is what we will be referring to as a break of market structure or a change of structure. All right, so previously we used to call it change of character, and then this is a break of market structure, right? So if it happens to be that it just comes back to this low, we are not saying it is shifting bearish until that demand is being taken out of the market. So once the demand is being taken out of the markets, we are going to be seeing a fair value gap, like an inefficiency in line with a demand, with a supply zone. So price really trace back into it and then continue to sell, breaking structure and violating the opposing structure also. Break a structure, break a market structure, and it continues that way until it is now drawn to the external low right there. So we're not having various structural break from, like, all those bullish structure is being taken out of the market and we are going bearish. Now also there are some other cases where we are drawn to the external high with a bullish trend, filling up every area of inefficiency from the range, and we now see price trade higher, taking this high. Now when you see price hunt this high, take that buy stop, we are not expected to sell. Now this explains to you that there is a reason, there is a catalyst to why this high has been taken out. There is a cause to why this high has been taken out. So that is when we be paying attention to areas of inefficiency or a demand zone, because that demand or inefficiency was created to take this high out of the market, to take that liquidity from the high. There was a pump of money that caused an impulse or a rally, or an impulse to go for the high. So once we see that hunt, we are not expected to start shorting, unless you want to counter trade, which is very risky. So what we are paying attention is what took that external high. Is that internal range liquidity that was responsible to take that external high. So now what we're paying attention to is to watch it come back down into that course of liquidity sweep, and then it will start to sell. Sorry, it starts to buy. And this, in this case, this is where markets took an external high and refused to sell. It continues to go higher, and that is when you're gonna see a very strong impulse as it is running and running and running most times. All right, but if it happens to be that we traded into the chorus of that structure, of that external high hunt, liquidity hunt, and we see it trade higher again and failed, we are not still gonna short. We still want to see it get violated, and once that violation occurs, that is when we'll be taking our shot and we'll be targeting external range low. So this is how we do it. This is just a breakdown analysis on a gradient due range, how you deal with range, understanding liquidity also. So now we'll be looking at the dollar index and you'll see the future outcome about it. So right now, from the 12-month time frame or higher time frame, this is our external high and this is our external low. Now if you also do pay attention, you notice that this low took liquidity from this low, which is the liquidity sweep that we're having right here. This is the purge. All right, so now looking at this range, this high and this low, we can actually see that we are having areas of inefficiency right here, right? So if price is to sell, right, we'll see trade into that inefficiency with a bullish structure, and then that bullish structure fails and change bearish. That is where we can say that, okay, the fair value gap or area of inefficiency is validated, and we can now look for a long-term short. All right, for a year or 2 years, depends. So yeah, so after we purge this liquidity right here, you can actually see the market was ranging on that low. So you can actually tell that this is a purge, is a manipulation going on, and we finally see that impulse trading higher and taking this high. All right, we do also trade it into the inefficiency that we have. Now another thing that you should be doing is taking your Fibonacci, marking your high and your low, so that you can know your, marking the high and the low, so that you can know your premium, discount, and your area of equilibrium. You can actually see we trade into the equilibrium and we came back down to discount, buying from that discount level. So once we bought from that discount level, we now see that the dollar index did a structural break right here. It took a high. All right, so what is responsible to take that high? We can see that we have a discount, and in that discount we have a fair value gap resting right there. All right, and also this sell candle, most of us we also refer to that as an area of order block or an area of demand. Okay, so 2025 traded lower into that area of inefficiency and also the area of demand, and then this year opened, and when this year opened we can actually see that we did a liquidity sweep. Now this is where we'll be paying attention to, because that is now a D range that we'll be trading with. So this is our low, previous year's high, and previous year's low. That is the range that we'll be dealing with, and we'll be paying attention to see if it goes to this high, and then target to see if in more years to come, like next year, we'll see if we would like to go for that external range high, unless it fails to. All right, so we can now run down to the 6 months time frame. This is it on the 6 months time frame. This is our day range high, this is our day range low on the long term. You can actually tell this is a ranging market. You can't tell this is bearish or bullish, but a ranging market. So it's a perfect day range for us. So the 6 months time frame, you can actually see this high, see this low right here. We traded higher, and we came back down to area of inefficiency, which has a big, massive order block right here, which is the sell candle, right? Then 3 months time frame. On the 3 months time frame, you have to refine this. This is the only area where we have inefficiency, and that is the fair value gap that we're talking about, right? So those also that mark supply and demand. We mark the last candle before the inefficiency. That is the area of demand. All right. So also we can actually tell that when we took out this high, this structural break, we ranged here also, building up liquidity. So this is an area of liquidity, has an inducement. So there's enough liquidity right here, because this is an area of support. If you look right here, you can actually see this is a pool of liquidity, relative lows. So it's making sense that price took that liquidity and buy the liquidity below, right? So now we can now go to our monthly time frame. This is our monthly time frame, and you can actually see that the market was ranging right here until 2026 opened, and we did a hunt on previous year's low. Now this is where it starts to get interesting right here. Now if you pay attention, this is where you can now understand what accumulation phase is all about and what Wyckoff is all about. You gotta see we traded higher, we came back low, we took an external low right here. When we took that external low, price was purging that low right here. This is a liquidity purge. So seeing that this is an external low, and we have stop loss below this low, we have stops, liquidity resting on this low, and then price starts to push right there, we can actually tell that this is accumulating the liquidity resting on this low. All the stops resting on this low, that is an accumulation of price. Now this year opened, and when this year opened, we see it traded lower. We took previous year's low, and we have now paying attention to what is responsible to take this low. It is this fair value gap that we have here. Now you can actually see that that fair value gap got violated, and we now have a break of that high, and also this high. All right, now all of these highs inside our previous year's high and low are internal liquidity. All right, so price will be seeking to go for all of those internal liquidity, and then seek to go for the premium pricing and for the external high. So if you study the Wyckoff, you can actually tell that this was building up accumulation phase right here. All right, so once the accumulation phase was completed, we now see it trading high. Now this is the completion right here. We have a spring right here taking a previous year's high, you can actually see how we impulsively trade higher, violating that favorable gap that was responsible to take this low, right? Violating it, and price retrace back toward the demand zone responsible for that. So we trade higher, we came back down to the demand zone, and then we trade higher again. So we have now taken out this high. This is from June. All right, this is previous month high because we are currently in July. All right, so now what I'm paying attention to is if eventually price have to retrace back, I'm looking at this area right here for it to trade back into, because it's also actually responsible to take this high. So if it could if it will eventually retrace back here, we're still looking for bullishness on DXY, and we're paying attention to it trading into this premium pricing right here. We have an area of inefficiency at that premium pricing, so we're looking at in between $106 and $105. If it breaks this fair value gap or this inefficiency, that is when we're looking for the external high. So we say we take liquidity from previous year's low and we'll be drawn to liquidity on previous year's high. So when 2027 occurs, when 2027 opening price starts, then we can now have a directional bias. But for this case, we can actually see how 2026 was formed, and we can tell that this is an accumulation phase for the dollar index to go bullish, and it confluence with what the war is actually going on, right? The US-Iran war concerning the oil. You can actually see how the US oil is actually behaving, and the dollar index is gaining strength, while currencies in Europe like the euro and the pounds, the European country, the Europe and the pounds are going bearish. All right, so that is it for the dollar index. Still, we have our eyes on this fair value gap right here. That is a very interesting area because it is actually at a premium pricing. So we'll be looking forward for price to trade into that area. So if it trades into that area and we start to see a range in market, and then we see a shift, then we can tell that, yeah, a distribution phase has occurred on the dollar index, and we're looking forward to trade lower. So that could possibly be starting from 2027. Then we can now look at euro. This is euro, and we'll be using FXCM, and we're looking at the 12-month time frame so that you can have a clear understanding of how it works. It looks like. So for the euro, we have high, low, high, low, high, and we traded lower. Now the area for demand that we have on euro is actually resting right here. And we can say it traded into this fair value gap, right? But we still have a demand resting right here. Now, if you are trying to buy, you have a point of interest on which is like a demand, and you want to buy from there, you'll be paying attention on how price trades into it. It comes into it in the bearish market, taps your order block, your demand zone. If this high, the responsible to trade lower into that order block is not violated, then you know that your demand zone is not valid to buy. All right, so but if that high is violated impulsively, right, you see inefficiency, you see that impulse, the inefficiency and the demand zone is being created, that is when you start to buy. But if it fails, or we just have a sweep on that high, it is not a strong confirmation for you to buy from that demand zone. Price will play around and then finally sell, kicking you out of that market. So you should take note of that. This is how you do your confirmation entry. Okay, so that's what we now have in Euro USD. We have high, low, we have high, and we have low. Price traded higher, but we have no violation to show that we are still going to go bullish on the Euro USD, because we have this high and we have this low right here. This is our daily range from for Euro USD, and this is the previous year's candle. We can actually see that when this market opened, the first quarter traded higher, and we swept this previous year's high. We can now go down to lower time frame and we'll take a very close look at that. This is it. High, low. Price retraced backward into the premium pricing. Did you see any confirmation right here that it has shifted bullish? No, it still has not taken this high, so we can tell that this wants to still maintain bearish, but we can also already tell that yeah, it is also ranging right here. So that is a deal range for us. So this is it. Very clearly on the 3-month time frame, high, low, price retrace backward into the premium pricing, and it starts to sell. This is the monthly time frame, high, deal range low. This is the equilibrium, price traded lower. This is where we had a sweep, price possibly trade higher into the premium pricing, and you can actually see that it starts to range right here. And when 2026 open, you can actually see trade higher and took out previous year's high. This is where the accumulation phase, because this is where the distribution phase occurred, because we can actually see we have a markup. It is now overbought, so it needs to distribute downwards into an area of discount. So we'll be having eyes on this fair value gap, while we're also looking at it to be drawn to this sell stop liquidity that we have right here, and also this one, because they are very close. They are still liquidity, right? So weekly time frame, this is it on the weekly time frame. This is where we traded higher, high, low, weakness in bullishness, price range, sweep previous year's high, accumulation phase occurred. So this tells you where the market wants to go to. We want to be drawn to this liquidity resting on this low. Once we trade into that liquidity, I think the year should possibly be ending, and we'll be trading into this fair value gap, and we'll pay attention to how it's going to react on that area. So this is a brief explanation. So yeah, I would like to see your review, what you think, your thoughts. Share it on the comment section. See you guys next time. Take care and be safe.